Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through all that market weakness. I'm your lead analyst, and with me, as always, is our market skeptic. Today, we are putting a true giant of global infrastructure, American Tower, ticker AMT, through a serious structural stress test. And look, this isn't just about skimming a quarterly report. No, we're here to test the very foundation of a company that, let's be honest, underpins our entire connected world. We're going to examine the raw materials, check for any stress fractures, and really determine if this structure is built to last or if it's starting to show some signs of critical failure. So you're going to want to buckle up. We are about to put this tower to the test and see if it stands tall or if it's at risk of coming down. Let's get to work.
All right, so here it is. This is the central conflict. The whole reason we're putting American Tower under the microscope today. The company just posted a fantastic year. I mean, the full year 2025 results show an 8% growth in attributable AFFO per share. And for those of you keeping score, that's adjusted funds from operations. It's a really key cash flow metric for a REIT like this one, and it basically shows you the cold hard cash they can actually return to shareholders. They beat the analyst estimates. By all accounts, the engine is absolutely humming. And yet, what was the market's reaction? A collective yawn. Maybe even a slight step back. Now, this is the kind of disconnect we live for here at Iron Financial, because when you see strong performance meeting weak market sentiment, it means one of two things. It's either a massive overlooked opportunity or it's a classic value trap. Our job today is to figure out exactly which one it is.
Okay, so before we start hammering on the walls and looking for weak spots, we have to understand the original blueprint. We need to look at the structure as it was designed and built in 2025. This right here, this is the foundation that everything else rests on. And honestly, the numbers tell a story of a company that was just firing on all cylinders, executing its strategy with some serious precision. The real question is whether that foundation is strong enough to withstand the headwinds that we can all see forming on the horizon. So let's start with the cornerstone metric.
Yeah, this 8% growth in attributable AFFO per share for the full year 2025. This is the big headline. In the world of massive capital-intensive infrastructure, an 8% growth number isn't just good, it's a real statement of operational excellence. It tells us that despite everything that's been happening in the global economy, inflation, geopolitical drama, supply chain nightmares, the core business of leasing out space on cell towers is fundamentally robust and it is growing. This is the cash flow engine that powers the entire enterprise. It's the bedrock.
And this is where the new growth is coming from. While that core tower business provides incredible stability, you can think of the data center segment as the high-octane fuel being poured on the fire. A 14% revenue jump, that proves that American Tower isn't just a tower company anymore, not by a long shot. They are aggressively, and I think smartly, positioning themselves right at the heart of the next huge wave of digital transformation. We're talking AI, we're talking cloud computing, and the absolutely endless demand for data processing. This isn't some little side project. It's a critical component of their future blueprint. It's a deliberate pivot towards higher growth assets.
And here is the raw power behind it all, $1.82 billion in adjusted EBITDA, and that's for the fourth quarter alone. This number is all about operational profitability. What it does is it strips out all the accounting noise and it shows you the pure, unadulterated cash-generating power of their assets. This is what you get from disciplined cost management and the inherent operating leverage in their business model. Think about it. Once a tower is built, pretty much every new tenant you add is almost pure profit.
All right, analysts, these are some impressive headline numbers. I'll give you that, no doubt. But the market is always looking forward, right? Isn't this all just a victory lap for a race that's already over? It feels like we're just staring in the rearview mirror here. That is a very fair question, skeptic, and that's exactly why this slide is so important. We're not just looking at their internal performance in a vacuum, we are stacking it up against what the smartest guys in the room, all the Wall Street analysts, were expecting. And on every single key metric, they didn't just meet expectations, they blew right past them. They beat on the bottom line, that AFFO per share, and they beat on the top line, total revenues. So this tells us that the strength in 2025 wasn't just good, it was actually better than anyone anticipated. The foundation is solid. But now it's time for the stress test.
And this is where the first real tremor hits the structure. A solid foundation is great, but what happens when one of your main tenants, a big one, just decides to stop paying the rent? Dish Network, a major customer, has defaulted. Let's be clear. This isn't a minor hiccup or some rounding error. This is a direct, hard hit to the revenue stream from a significant client, and it is the first major test of this company's resilience. How a structure handles a direct impact like this tells you everything you need to know about its real-world integrity.
And let's be crystal clear about this. This is not some analyst speculation. This is not media hype. This is a direct quote from American Tower's own management on their earnings call. They are not sugarcoating it one bit. The words defaulted and negatively impacts are as clear and as serious as it gets. They are openly acknowledging a material event that will damage their 2026 numbers. And what's more, it also raises some really serious questions about counterparty risk across the entire industry. I mean, if a national carrier like Dish can just default, who else out there might be vulnerable? So the crucial question now is, how are they handling this? What's the damage control plan?
So here's the company line, analyst. They say they're just ripping the Band-Aid off. We've de-risked the business by taking it out of the numbers. In other words, their entire 2026 guidance assumes they are going to get $0, not a penny, from Dish. So anything they manage to claw back in court is pure upside. And okay, it sounds smart, like they're isolating the problem and putting a fence around it. But is it really that simple? Is this a controlled demolition of just one part of the business? Or did the Dish default just expose a major fault line that runs deeper, maybe through the entire structure? That is the real question here. They've contained the number, but have they actually contained the risk?
Exactly. And that leads us directly to the next phase of our stress test. This Dish issue isn't happening in a vacuum. We're starting to see other potential stress fractures appear, and they aren't just here at home. You know, if you find one crack in a foundation, you don't just patch it and walk away. You have to check the rest of the foundation for more. You have to determine if the weakness is localized or if it's systemic. So let's take a look at their global operations and their other business segments.
And this chart tells a tale of three completely different companies operating under one roof. On one hand, you have absolutely fantastic performance in Asia-Pacific and Africa, growing at a blistering 8.5%. That is a powerful growth engine, and it proves the global thesis can absolutely work. Meanwhile, developed markets like the US are just chugging along at a respectable, stable, predictable mid-single-digit pace. But then you look at Latin America, a 3% decline. That's not a slowdown, folks. That's a reversal. It highlights the serious volatility and risk that's inherent in their global footprint. So this isn't some monolithic, stable structure. It's a complex assembly of different parts, and some of those parts are clearly under some serious strain.
So let's get specific about these cracks. This isn't just a feeling. Management laid it all out themselves. In Latin America, they're facing an 8% churn rate. Think about that. That's a huge number of tenants just up and leaving, which is what's driving that revenue decline we just saw. Then you look at the data center business, their supposed big growth engine, and they're guiding for a 270 basis point margin decline next year. Why? Well, some one-time benefits they got in 2025 are rolling off, and power costs are higher. And finally, their lower-margin services business is growing, which might sound good at first, but it actually dilutes the overall profitability of the company. So let's recap. You have a major tenant default at home, you have high churn abroad, and you have margin pressure in your two other key segments. That's not a challenge on one front, that's a multi-front battle.
Okay, this is the pivot point. Acknowledging the cracks is one thing, actually reinforcing the structure is something else entirely. And this is where we see management's plan to fight back against these pressures. They are not just sitting there watching the crack spread. They are actively investing in new materials and new designs to strengthen the business for the future. The focus here is on two key areas: tapping into the massive growth potential of AI and executing a disciplined plan for operational efficiency. This is the heavy lifting. And the primary tool for this reinforcement is CoreSite. Now, this isn't just a collection of buildings stuffed with servers. CoreSite is a strategic platform of highly interconnected data centers. The best way to think of them is as the critical intersections and the major highway interchanges for the internet. They are specifically designed for the kind of high-density workloads that AI and advanced cloud services absolutely demand. I mean, AI doesn't run on your laptop. It runs in places exactly like this that have immense power, cooling, and fiber connectivity. By acquiring and investing so heavily in CoreSite, American Tower is betting that the future of data isn't just on your phone, it's in these centralized, incredibly powerful processing hubs. This is their offensive strategy.
And here is the defensive strategy. In direct response to those margin pressures we just identified, management has laid out a clear multi-year plan to become a much more efficient company. They're not just trying to grow their way out of the problem, they're getting their hands dirty and working to fix the core profitability. This plan involves globalizing their operations to find efficiencies of scale, getting a lot smarter on their biggest costs like land leases and supply chain, and taking the best practices from their most efficient markets and applying them everywhere. And the target is concrete. They want to expand tower margins by 2 to 3 full percentage points by 2030. It's a long-term fix for a very near-term problem. All right, now we get to the core materials. After assessing the operational blueprint and the strategic reinforcements, we need to analyze the financial bedrock of the company, its balance sheet.
You know, a company can have the best strategy in the world, but if the balance sheet is brittle, it will shatter under pressure. We need to see if American Tower has the financial strength and the flexibility to actually execute its plans and weather this storm. This, right here, is where a company proves its mettle.
And this chart, well, it shows us a picture of pure discipline. When a company has cash, it has choices. And American Tower's priorities are crystal clear and very methodical. First, they pay the dividend to shareholders, and as a REIT, this is absolutely essential to their structure and their investor base. Second, they invest in capital expenditures to maintain and grow the business. After that, and only after that, they look at the most opportunistic use of the cash that's left over, either buying back their own stock if they think it's undervalued, or paying down debt to further strengthen that balance sheet. There's no wild speculation here. It's just a balanced, prudent approach to managing their capital.
And they are absolutely putting their money where their mouth is. They have a board-authorized share buyback program with $1.6 billion of firepower remaining. This is a significant signal for management. It says, loud and clear, that they believe their stock is a good investment at its current prices. For us at Iron Financial, this is a key indicator. They're not just managing the business. They are actively managing the stock's value for their shareholders. It's a powerful tool they can use to directly support the stock price and return capital when they feel the market is undervaluing their long-term prospects. Okay, analyst, I have to concede, this is a powerful piece of evidence. A company can't fake this. For more than a decade, through recessions, through market crashes, and huge technological shifts, American Tower has increased its dividend every single year. You just can't do that with a weak foundation or with fickle cash flows. This speaks to a deeply ingrained financial discipline and the durable, predictable nature of their core business model. This really is a testament to the long-term structural integrity of the business.
And let's close out the balance sheet analysis with this knockout punch. They are actively deleveraging, bringing their net leverage down from 5.1 times EBITDA to 4.9 times, getting it right back into their target range. This gives them immense financial flexibility. And perhaps most critically in today's volatile interest rate environment, 96% of their debt is at a fixed rate. This insulates them from rising interest costs and provides a huge amount of stability and predictability to their expenses. They have effectively built a financial fortress, locking in their financing costs for years to come. The balance sheet isn't just strong, it has been forged for resilience.
So, we've run the stress test. We've examined the blueprint, we've identified the cracks, we've reviewed the reinforcements, and we've tested the core materials of the balance sheet. Now it is time to put it all together. All the evidence is right here on the table. We need to weigh the structural strengths against the visible weaknesses and come to a final verdict. Is this a skyscraper in the making, or is it a house of cards?
Okay, here it is, the final blueprint. The bull case, the opportunity case, is clear. If you're a bull, you're betting on the future. You're buying into the massive growth tailwinds from AI and the data center boom through CoreSite. You're trusting a management team that has laid out a credible, long-term plan to expand margins and improve efficiency. And you're backed by a fortified balance sheet and a proven, decade-plus commitment to shareholder returns through dividends and buybacks. This is the case for a sound structure that's making all the right moves to get even stronger. But the bear case, the trap, is just as compelling, analyst. I mean, the Dish default is not a small crack. It's a significant blow that materially impacts the 2026 outlook and raises serious questions about their other tenants. The high churn in Latin America proves that their global footprint isn't immune to risk and volatility. And the weak guidance for next year, plus the margin pressures across multiple segments, it all suggests that the near term could be very, very painful. The bear case argues that the market is right to be cautious, that these cracks are signs of deeper problems that all these reinforcements might not be able to fix.
And so that is the fundamental question that you have to answer as an investor. Has this stress test revealed a fundamentally sound structure that is wisely using its resources to reinforce itself for decades of future growth? Or have we uncovered a foundation that is starting to crumble under the weight of all these new pressures, with management simply applying cosmetic patches to cover it up? The answer to that question will determine whether American Tower is one of the great portfolio forging opportunities of the year, or just another trap waiting for the unwary. The analysis is done. The verdict is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.